Hello and welcome to this AFM Topic Explainer video. My name is Milind Date and I'm an expert tutor for the AFM examination. In this video, I would focus on the principles and methods of valuation in the events of acquisitions. This is a syllabus area that is quite often tested in the AFM examinations. If you see past several years exams that are published by ACCA. Mind you, the scenarios can be really complex, comprehensive, and very demanding for the students. And therefore, students need to spend sufficient time in developing their learnings and practice actually as many exam type questions as possible. Let me tell you right in the beginning that this is not a teaching video, but this will provide you with some kind of a context within which you should organize your learning and prepare yourself for the AFM examination. So let us first look at what are different syllabus areas wherein this topic of valuation of acquisitions is included and elaborated. It's in the section C2 of the AFM syllabus and study guide. So if you just have a look at expectations, they are very clearly provided over there. And the word that is used, the phrase that is used is estimations. Naturally, when you talk about estimations, these are not always straightforward calculations. It's an estimation based on consideration of various parameters and various pieces of information that is provided to you within the context of an organization in the AFM examination. So estimating growth levels, estimating the value created from acquisition using different models, applying various methods to the process of valuation, and as against the regular existing organizations, how do the valuation exercises done in case of high growth startups and loss-making companies. Of course, in this video, I'm not going to highlight much about the high growth startups and loss-making companies. Maybe that will come up as another video in future. But please note that it's very crucial for you to understand the mechanism of valuing both a target company, based on which you can, of course, decide the price that can be negotiated, and valuing the combined company also to assess the impact that the acquisition creates on the shareholders' value. And in applying various valuation models, approaches, and techniques, estimating growth levels is an important factor, because that's how you assess the future performance of a combined company. And the models for estimating values, you can bring back your FM knowledge, wherein you would have studied the asset-based models, market-based models, and cash flow-based models. Please get this carried forward knowledge back from your AFM examination. But when you're learning them now, please remember it's the advanced level application of these models will be tested in the AFM examination. Valuation methods would include generally the estimations of changes in the risk profile of the acquiring company, combined company, estimating the risk-adjusted cost of capital, the concept of adjusted present value, and as an effect of change in the entire structure, whether the price to earning ratio of the combined organization is going to change or not. So in the examination, it's not just one set of numbers that you need to calculate, but it's a wider range of various calculations that you need to come up with by application of the models and methods step by step based on the information given to you in the scenario. And mind you, this information may not be given in a logical sequence. You may have to study, learn different paragraphs, and then try and establish a linkage between various pieces of information. And this, my dear friends, would require a lot of question practice. And therefore, this topic is really very, very crucial for the entire examination. When you're valuing companies that are involved, of course, in the acquisition, the changes in the risk profile becomes a key consideration. Now, what sort of risks? Generally, these organizations can be facing, and you as a student will be confronting through the examination questions. Let's look at those risks and let's see how does one deal with them while attempting to answer the tasks in the examination. Primarily, you talk about two types of acquisition related risks. Number one is the business risk, and number two, the financing risk or finance risk. Acquisitions could result into changes in the risk profiles of both the companies, acquiring company as well as the target company. And as the risk profile changes, it could lead to change in the cost of capital, which could in fact affect the estimation of present value of cash flows, because we know the cost of capital is used as a discounting factor while calculating the present values. And this, in all, could relate to change in the valuation estimates. Well, when you talk about the business risks, it's all about volatility of the earnings of an organization. Some organizations could be cyclical in the nature. Some could be, related to an environment which itself is very, very volatile. In a multinational environment, it could be sort of a political risk backed by business risk. When you talk about volatility of earnings in financial terms, you know very well, and you have studied the concept of asset beta in the AFM examination as well. So the business risk is measured by asset beta. And calculation or estimation of asset beta from the given set of information could be challenging if one doesn't practice a lot of questions. On the other hand, of course, the financial risk is dictated by the capital structure of the organization, the composition of equity and debt elements. And the way in which the new acquisition or acquisitions are funded is likely to dictate whether there is a change in the finance risk or not. The method of financing used could be leading to change in the finance risk. For example, if currently the company is all equity funded, and now the new acquisition is likely to be funded from use of debt, there could be a change in the finance risk. And like I said, business risk was expressed in terms of asset beta. The finance risk would be expressed in terms of equity beta. How to make use of the given formula, beta formula, in the formula sheet for calculation of asset beta and equity beta, and then how to make use of the capital asset pricing model to estimate the cost of equity, and various other ways in which you can determine the cost of debt, and then combining the two in the market value proportions gives you the weighted average cost of capital, which in fact can be used as a discounting factor if you're using cash flow method of valuation. So observe very closely the relationship between these different determinants of value and how the calculations can become complicated from the given scenario, and then you will need to resolve each and then come up with the best possible estimate. So which are those acquisitions which can lead to changes in the risk profile of the acquirer or the target company, or both? Please remember, the examination scenario will never tell you that this is a business risk, or that this is a finance risk, or this is a type of acquisition. No, it will only elaborate on the nature of business. It will also provide you with the data on how the business is going to seek for acquisition and how that acquisition will be funded. Now, you will have to put together all these disconnects, and the connected dots will tell you what is the asset beta, what is the equity beta, what type of acquisition it is, and therefore what type of valuation method that you need to make use of. However, in this video, let me quickly take you through certain types of acquisition. But please, again, with a pinch of salt, these types are not mentioned directly by the examiner. You will have to infer them by interpreting the information that is given to you. Simply speaking, you can split the types of acquisition based on or within the context of the two risks that we spoke about, and then choose the method of valuing the acquisition. First is a simple acquisition where there is no change in the business risk, neither there is a change in the finance risk. For example, one telecom company is considering taking over another telecom company, same business. So for the acquirer, there is not going to be any change in the business risk, not at all. And if the acquisition is going to be funded in the proportion of existing capital structure of the company, there won't be any financial risk also. Of course, this is oversimplified version that I'm telling you, and therefore could be very rarely found in the real life as well as in the AFM examination. Another type is, continuing with the previous example, that look, one company, telecom company, trying to take over another telecom company, but the existing acquirer is using hardly 10% debt in its capital structure. Now the entire new acquisition is proposed to be funded from debt, a huge amount of debt, which could change the existing composition of 90% equity, 10% debt to probably, let's say, 60% debt and 40% equity. If that be the case, there will be a change in finance risk, although the business risk remains same. And the third type of acquisition could be a case where an acquirer company, a telecom company, is likely to take over a technology company, where now the business is entirely different from the existing business of providing telecommunication services. Here, the acquiring company that is in telecom, but the target company is engaged in development of software for any other business application. And that is backed up by the fact that the acquisition is funded by extra debt. The third type would necessarily involve change in both business risk as well as the finance risk. As I said, please remember, examiner is not going to tell you directly what type of acquisition it is. However, you need to infer it based on the information given and the ability to interpret that information. The type of acquisition definitely would affect the extent to which cost of capital of acquiring company changes. And remember, you will have to make use of this cost of capital, the new one, to discount the cash flows. And therefore, that's an important aspect that you need to be careful about in the examination. As I said, exam question does not specify what acquisition type it is. You will need to interpret it based on the information given. So let's now look at valuing the acquisitions that have no change in the risk, absolutely no change. Here you can recall all your FM carried forward knowledge. These are simple methods that you can use. Asset-based methods, book value, market value, replacement value, etc. But in a real life scenario, asset-based methods are very, very rarely used. In examinations also, if at all there is a task where you have to use asset-based methods, it will not carry a large number of marks. Secondly, you could make use of relative models like PE multiples or price to book value ratio, etc. And the cash flow models that are very, very commonly used. Cash flows could be generally used with the help of dividend valuation model, free cash flows for equity, free cash flows for a firm, etc. The discount rate that we should use be the acquiring company's weighted average cost of capital if we are using FCFF based calculation, or it could be cost of equity, especially the geared equity, if you are using dividend valuation model, dividend growth model, or free cash flow for equity based calculations. And naturally, of course, I mean, if you determine the total company value using WACC of free cash flows for firm, the value of equity can be inferred by deducting the value of debt from this total value of debt, from the total value of the company. If there is a change in the finances, then what do? Well, we have dealt with this change in the method of funding in the topic of advanced investment appraisal, wherein we have already seen how to make use of the adjusted present value technique. As the debt is primarily used to finance acquisition, there would be a change in the capital structure and therefore the cost of capital. So here, for valuation purpose, you can make use of the adjusted present value or APV method, wherein you know how to make use of the ungeared beta, that is the asset beta, to discount cash flows of the target company, including, of course, any synergy benefits if that are available. And then for funding through debt purpose, you could calculate the present value of various tax shields that are available, and the debt related cash flows need to be discounted at a pre-tax cost of debt. So the base case present value calculated using ungeared cost of equity plus the present value of tax shields, which we used to call as financial side effects when dealing with advanced investment appraisal, these two combined together will become the adjusted present value for the purpose of acquisition. And naturally, from this total value, if you deduct the market value of debt, you would get the value of equity. And this value of equity could be a proxy for the maximum price that can be offered by acquiring company to the shareholders of target company. So depending upon the question, depending on the context and the details available, you need to decide whether there is a change in the risk. If the answer is yes, which risk is changing and therefore, which valuation method should I be using? With no change in the risk, calculations are relatively the simplest. With change in the finance risk, they become a bit complicated in the sense that you will have to do all the calculations for calculating ungeared cost of equity and then discounting the cash flows, calculate the cost of present value of the tax shields, discounting, taking the pre-tax cost of debt, and then calculate the adjusted present value. What if both of them change? That's really crucial. And most of the times in the examination, there could be a scenario where you would be facing the change in the business risk as well. So you need to determine the risk-adjusted cost of capital and then use it to discount the cash flows. How does one deal with the estimation of risk-adjusted WACC, weighted average cost of capital? First of all, you need to calculate the asset beta of both companies. For this, of course, you will have to use the asset beta formula very carefully. Also, make sure that you consider market values of debt and equity as weightages in the formula. Once you do that before acquisition, then determine the average asset beta of a combined entity after acquisition. And then you re-gear this asset beta to reflect the gearing of a combined organization. Now, you will be given all that data, but what you will need to do is to collate it together properly and then calculate the risk-adjusted weighted average cost. Post-acquisition cash flows, including synergies, will then be discounted using this risk-adjusted weighted average cost of capital, which will give you, of course, the net present value. And naturally, to get the equity value, you will have to deduct the value of debt. So it seems to be a simple way, a simple area if you look through these parts of the video. But please remember, as I said in the beginning, the information given could be very comprehensive, detailed, and a bit complex. Every parameter will have to be carefully learned and then applied in the examination. Now, let's see how this syllabus area is tested. I have said that this is one of the most tested areas in the AFM examination. Now, on this particular syllabus area, the question could be set as a part of 50-mark question, section A, or 25-mark question B, along with, of course, now the professional skills marks. So every syllabus area, when you confront any question in the AFM exam, there will be professional skills marks available. Now, let's see how this is typically questioned. Obviously, one simple approach could be estimate the value created for the shareholders of acquirer as well as target company. And when you talk about value creation estimation, of course, naturally, the logic says you should calculate the values before acquisition, calculate the values after acquisition, and then see if there is any additional value created for the shareholders. You may be asked to comment upon validity of various assumptions that are made in estimating these values. Whole list of assumptions, like growth rate by itself is an assumption, or synergies could be assumed. So please note from the case scenario, which all are the numbers wherein you feel that the assumptions are a bit unrealistic. You raise a question on that. You would get marks for skepticism skills, no doubt. Question could ask you, what is the maximum price that you can offer for acquisition of a target company? As I explained earlier, this could be equivalent of value created for the equity holders of the acquiring company. And that's the maximum that you can provide. Anything over and above that would mean the acquisition is completely unsuccessful so far as the acquiring company shareholders are concerned. You may also ask a question in a different language, asking you to evaluate whether or not the acquisition would be beneficial to either acquiring company shareholders or target company shareholders, either in absolute terms or in terms of a percentage gain as such. There could be a question wherein a discussion on likely reactions of the shareholders on the proposed acquisition, its benefits, its synergies, its value created, etc. And one more way in which the topic could be questioned is the valuation with consideration of a new project. You might have identified a target company, and the target company might be contemplating a new project at that point in time. You may therefore be asked to determine the net present value of that new project, which will in fact increase the value of the target company further, and therefore expected price by the target company shareholders also will have an effect on itself. Any question of these types, for you what is important is read the task absolutely carefully. Without that, you will not be able to answer what has been asked. And then within the context of that, you need to read and understand the information given. Identify who is acquirer, who is target, what business they are in, what risk is going to remain same, what risk is going to change, how do you calculate the growth rates, how do you ensure to correctly estimate the cash flows, the synergy effects, the asset beta, the equity beta, gearing, re-gearing and ungearing process, application of the equation, which is part and parcel of the formula sheet. All this is to be very carefully observed. Information provided to you is not in an integrated way. And therefore, students generally find this difficult to interpret and relate together in the time of the examination. Solution is only one. Please make sure that you do a lot of question practice on this topic as well. ACCA practice platform, as I always keep advising, is the best possible resource for that. While attempting these questions on valuation, please remember, students have this misconception. If I'm able to do the calculations, I get a pass. Calculations will fetch only a few marks. More marks are available for discussion, analysis, and advice. Many times, in fact, examiner may require you to provide a reasoned estimate of values. So every time you provide a value, you will have to explain how that is calculated, what are the assumptions behind it, what is the theoretical model that you have used, and then how have you arrived at the calculated value. This is how you will have to articulate your answer to get both technical as well as professional marks. Learning resources. This topic, valuation for acquisitions, is explained in the ACCA AFM Study Hub, chapter number 8.2. Carefully study that. Question practice, of course, practice platform. And to understand the examiner's observations, please go through all the examiner reports published by ACCA. This topic, when you learn, please remember, you will have to bring in the knowledge from other syllabus areas as well. Like for example, chapter 3.1 of the AFM Study Hub resource related to WACT. Chapter 4 related to use of CAPM and betas. And then chapter 7 for valuation models. In summary, what have we learned? Valuation is a complex task, no doubt, where you need to consider a lot of information and collate it together in a step-by-step approach. And therefore, you need to carefully consider the information and the linkages there. The calculations, whatever you perform, must be shown very clearly as a part of your working notes. Make use of the spreadsheet if you can, because that itself becomes an integral part of your answer. And then carry out appropriate discussion on the valuation outcomes, detailing the possible shareholder reactions, and commenting on whether the acquisition is likely to be successful or not. Giving your opinions, don't cut paste the information from the scenario given to you. So this is it in this particular video. I wish you all the very best for learning, and please stand by for the upcoming videos on this and many more other areas. Thank you very much.